Open a brokerage account for the first time, and you are instantly hit with a wall of terminology. Growth, value, blue chip, mid-cap, cyclical, 17 different classifications, all competing for your capital. Throwing money at these labels without knowing how they function is dangerous. It is like ordering building materials for a house without checking the specifications. You might think you are pouring a concrete foundation, only to realize years later you built it out of glass. To make sense of the market, we have to reframe how we look at these categories. These 17 classifications are not isolated, mutually exclusive products on a shelf. They are overlapping lenses used to evaluate the exact same assets. One stock can hold multiple titles simultaneously. You can have a single equity defined by massive size, cash payouts, and a pristine reputation. The most recognizable corporations sit dead center in this overlap. Take Coca-Cola. It is a large cap stock due to massive market value, and a dividend stock because it consistently pays a cut of profits. And it is a blue chip stock, well-established companies with a long history of reliable performance, because it has been delivering returns for decades. But you cannot have everything. The ironclad rule of the market is that you have to choose between volatility, yield, and growth. It is mathematically impossible to find a stock that gives you massive overnight expansion, zero price drops, and high cash payouts at the same time. Filtering through these classifications is not an exercise in memorizing financial trivia. It is the core blueprint for aligning market risk with your own personal timeline. To organize this taxonomy, we sort the market into 3 distinct categories. First are the preservers, designed strictly for wealth protection and passive cash flow. This group is anchored by large cap and blue chip stocks, massive, globally entrenched corporations that move predictably. Inside this group, you find defensive stocks. These belong to industries where consumer demand remains completely unchanged, even when the broader economy falls into a severe recession. People still buy bandages, baby powder, and essential medications when they lose their jobs. Companies making these basic consumer staples retain their revenue streams, while luxury brands lose millions. Because these mature companies do not need to build 100 new factories every year, they take their excess profits and distribute them to shareholders. These regular cash payouts are called dividends, and they form the foundation for a passive income portfolio. For even tighter security, you can look at preferred stock. This is a hybrid asset between a stock and a bond. It offers a fixed dividend, and if a company files for bankruptcy, preferred shareholders are legally entitled to get paid out before common stock owners. The trade-off for that priority safety is strict. By choosing preferred shares, you forfeit your voting rights, and you miss out on the exponential price appreciation that common stocks experience during market rallies. Allocating capital to the preservers buys you stability and consistent income, but that safety mathematically caps your upside. A globally established trillion-dollar company will not double in size overnight. If your objective is aggressive capital appreciation rather than safe yields, you have to move to the second functional bucket, the accelerators. These companies are defined by relentless physical expansion. They are built to rapidly scale their operations, hire thousands of engineers, and dominate entirely new markets. We classify these as growth stocks. Because they require every single penny of profit to fuel that expansion, they almost never pay dividends. The cash goes straight back into scaling the business. The alternative to that rapid scaling is a value stock. A value strategy involves hunting for companies with stable, fundamentally strong businesses that the broader market has temporarily mispriced or irrationally overlooked. The engine for most of this acceleration is market capitalization, which is the total dollar value of a company's outstanding shares. Small cap and mid cap stocks represent companies in their earlier growth stages, meaning they still have massive room to expand compared to the heavyweights. This chart shows exactly how that plays out. The smooth line represents large caps. The jagged line represents small caps. Small caps offer significantly higher peak returns over time, but you have to survive violently deeper price crashes along the way. That volatility is amplified with cyclical stocks. These are companies in travel, automotive, and construction whose performance is tied directly to the economic cycle. They print money during economic highs, but they are the very first to crash during a downturn. The accelerators are the only true engine for multiplying wealth, but they demand an ironclad psychological tolerance. You have to be willing to endure severe temporary portfolio losses without selling your positions. Finally, we reach the specialists. These assets exist on the extreme edges of the risk spectrum, or they serve highly specific structural niches. On the extreme speculative end, you have initial public offerings, or IPOs, and penny stocks. Penny stocks are low-priced shares of early-stage companies. Both carry massive risk due to low liquidity, meaning it is hard to sell your shares quickly, and a severe lack of reliable public financial data. When retail investors gamble on these unproven micro-cap companies, the typical result is a sudden, chaotic evaporation of their wealth. On the structural side, you have REITs, or real estate investment trusts. These are companies that own and manage income-producing properties. By law, they must pay out high dividends, giving you direct exposure to real estate yields without requiring you to buy a physical building. Other specialist categories act as filters. International stocks let you buy shares outside your home country to diversify geographic risk. ESG stocks, representing environmental, social, and governance standards, allow you to align your capital with specific sustainability and ethical practices. Then there is the complex mechanism of dual-class stocks. This is a structure where a company issues multiple types of shares, and each class carries a wildly different amount of voting power. This setup allows company founders to raise billions in public capital while entirely stripping those public shareholders of their ability to influence major corporate decisions. Specialist stocks are highly specific tactical tools and asymmetric bets. Because of their unique risks, they should never form the foundational core of a beginner's portfolio. Memorizing this 17-part taxonomy is useless unless you know which specific classifications belong in your portfolio right now. This chart shows the ultimate sorting mechanism, your personal time horizon. The number of years you have until you need the money dictates exactly how much market volatility you can mathematically afford to absorb. If you are nearing retirement and need the cash within 5 years, you follow the foundation builder model. Your portfolio should be heavily anchored in the preservers, large cap, blue chip, and defensive dividend stocks. By doing this, you are willingly trading the potential for future exponential wealth in exchange for immediate capital preservation and reliable cash flow today. If you have decades left to invest, you follow the growth optimizer model. This portfolio is weighted heavily toward the accelerators: growth, mid-cap, small-cap, and value stocks. With a long horizon, you must accept severe short-term market crashes. Volatility is the mandatory price of admission to outpace inflation and compound long-term wealth. In both models, speculative classes like IPOs and penny stocks should be treated strictly as entertainment or lottery tickets. They are not a retirement strategy. Stock classifications are not crystal balls for predicting the market. They are mechanical dials. You turn them to precisely control the amount of risk allowed into your financial life.